Welcome to our monthly trade floor video. I'm joined today by Portfolio Manager Rob Mead. Rob, let's start with what markets and rates have done this month.
Well, it's been another interesting month, Hugh. We've again tested all-time lows for Aussie bond yields. That was a bit earlier in the month. Since then, we came off a little bit as we approached the G20, when there was some expectation of some thawing of the trade war. We saw a little bit of that, but the markets have been quite quick to sort of move back towards their lows in yields. The really interesting thing is Aussie 10 years actually traded below the lowest level US 10 years ever got, even when the Fed was close to zero and quantitative easing was in full swing. So quite a lot of action last month.
At their most recent meeting, we saw the Reserve Bank here in Australia cut interest rates to a historic low of 1%. So what's our view on the Australian economy and how low can interest rates move from here?
Yeah, sure. It's another month, another rate cut for the trade floor video. So it's something that we're sort of getting a little bit used to. I don't think we'll see another one when we're talking next month. I think we'll probably get a pause. Now, if things deteriorate quite quickly, that might change, but we don't anticipate another one coming. What we have seen is most of the rate cuts be passed on, of the 50 basis points, most of it's been passed on by the banks to mortgage rates, which is great. So that will serve to at least stimulate the economy to a certain degree. How much we see from that remains to be seen. We've seen some interesting comments, and we were talking about that this morning, from the central bank governor, Lowe, and suggesting that the economy was okay. But really, at the end of the day, the only reason we're continuing to cut rates to all-time lows is the structural growth in the economy is quite weak. And so as investors, we always need to calibrate that and think about what that means for asset class returns.
And then I suppose turning to asset classes, and particularly fixed interest for our clients, in this now low and falling interest rate environment, where are we finding opportunities and how are we positioning portfolios? Yeah,
it's a great question. So the thing is, when rates are reaching these low levels, you sort of start to say, what's the reason to own some of these assets? And those reasons are still as true as they ever were. So the interesting thing is, so far, when we've gone through all these quantitative easings and lower rates, it's been against a backdrop of positive growth. So we haven't really tested an environment where growth starts to falter or we go into recession. So when you just keep lowering and lowering the discount rate, all risky assets should go up. It's only when you start to adjust earnings expectations that you can start to sort of see a different reaction function from risky assets. So if we find that the traction of fiscal policy, the traction of monetary policy accompanied by pretty benign fiscal, which is what we expect, if that traction starts to become less effective, then we may see less of a bounce in terms of economic activity. Now, in that environment, obviously we start to question some of those risky asset returns. And then the role of bonds, even though yields are low, continues to play those key roles of capital preservation, of income generation, and obviously diversification versus everything else in investors' portfolios.
Fantastic. Thanks, Rob.
Pleasure. Thank you.